So here we have the Alpha Capital Group weekly preview for the week commencing the 15th of January 2024. It's been a bit of a quiet, well, it's going to be more of a quiet week than last week's CPI Fest, which we obviously saw quite a lot of pushback from the US read-through. This week, it's retail sales data to see what the economy looks like and a continued look at US bank earnings, which have so far been mixed, but no real deterioration. We've got the Snorefest, which is Davos, the biggest jolly up in the world. Webinars only, please, if you're going to be serious about the global footprint imprint you're making. China are reaching some full-year GDP figures, which should give us a little bit more of a better idea where they are before they go into their New Year holiday. And there's some geopolitical issues out there with Trump back in the room. Obviously, it started off with Martin Luther King Day, just yet again one of these little pauses we could have done without. We just got a bit of momentum last week, sorting out the volatility. So all over the airwaves this week, it's going to be Davos. Ignore it. There's hardly anything of any note said there, and you can just see by the guest list, Macron's there, nothing to say. And guess who? Guess who turns up 3 times this week? My favourite, Lagarde, exit right. The IMF, surely we'd be better off with Tom Cruise rather than this character, the managing director. Kristalina, you've got the World Bank and the World Trade Organization trying to justify themselves. Snoresville, totally ignore it. The main action really this week is on Wednesday. You've got US retail sales data, the PCE data that's already come out from the PPI last week. So these are producer inflation numbers which get thrown into the Fed's favorite measure of inflation, the PCE, the personal consumption expenditures. As of yet, nothing's really fallen down. It's running at a low rate. The inputs are helpful, and retail sales have held up. So unless anything disturbs that, it's a nothing to do. As you can see, it's expected to be up 0.4 this month from 0.3 previously. And then we've got the other read through. Again, people have been struggling to get cheap mortgages. It's affected starts and home sales. They come Thursday and Friday. Again, not expecting much to change the consensus there. We've got a number of Fed officials speaking this week. Waller this afternoon. He is the major hawk of anyone that's speaking this week. Outside that, we've got a board member. He can't have any bias. Michael Barr. Bowman, another reasonable hawk, speaks on Wednesday. Then John Williams sneaks out. There's the Beige Book, which is really a nothing done chat about activity by industry sector, but he'll do the opening remarks. As we know by now, he can't resist making a comment, so he's not meant to be, but you never know. And then the Mild Hawks finish off the week, Bostic and Daly. Anything else going on? Well, I mentioned China in the preamble a minute ago. They've got full-year GDP figures in the morning, likely to affect the immediate outlook there. Obviously, we know that they're struggling. They're bailing out. Not a lot's likely to change the dial there, but their stock market has pulled back 60%. That's beginning to be chatted about. Any of us that are out there follow the charts, we're getting interested. Why? Because that's pretty close to 61.8. There must be a setup suggesting that's either the end of a move or we're expecting a short-term bounce. We don't cover China here, but it will have, the risk-on connotation overnight in the Asia sessions. So just keep an eye on it. Today's German CPI was in line. And then there's something you might see if you look at the diary, the ZEW sentiment in Germany. The ZEW is made up mainly of financial advisors. There's about 1,000 of them. So you can imagine it's like headless chickens most of the time, either panicking or getting overconfident. In terms of German surveys, you want to look out for IFO. That's similar to their ISM, and it's industry people. And given the fact that Germany's one of the biggest manufacturing economies in the world and obviously dominates Europe, then that's the one to watch out for. So ZEW only really matters if it moves a lot. EU CPI comes out tomorrow, so keep an eye on that. But so far, there's not been a lot of positivity coming out, rate cuts, and they're still trying to push back as being the last. Again, UK inflation Wednesday, both CPI and PPI. And so far, we've had employment data today. And that was a marginal positive, slowest wage growth in a year, so it's since last January. the figure came in ex bonuses plus 6.6 for the September to November period. That's pulling back from 7.2 for the 3 months ending in October. So it's a small directional positive, and we need all we can get in the UK. Net higher for longer versus is the first cut coming in May that the market is proposing. Not again, haven't seen anything to change that narrative yet, but keep an eye. And then we've got the old geopolitics. Hooty fruity, I've called it. It is kind of funny if it wasn't so serious. The US, I mentioned previously, had to act when they did, and the UK and US in combination, obviously, are coming under attack. And I've got to stand up to Iran. If if it were to move to the other side and start really affecting the Saudis, then the whole thing will escalate, and we've got a different thing. But for the moment, oil in the main, even though it popped, is ignoring it. I demonstrated that chart last week. There is an absolute downtrend in place, and we're only getting blip ups on, real geopolitical negatives, and the fact that the Saudis are panicking about prices, and there was a stockpile build, surprisingly, in the US. So, and yet, despite all that, it's still not flying through the roof. So, be aware of that, because when it all calms down, oil's probably going to start falling quite aggressively again. And he's back, isn't he? The man's in the room. Love him or loathe him. Trump absolutely smashed his way to the front in the Iowa caucus, and you perhaps got to start taking him seriously. Remember, his net position is one of being global trade negative, really, and the dollar strength in the short term, mainly because of risk avoidance. So the markets, I've used that as an excuse not to be happy, but again, even though I'm expecting one more high in some of these indices, I've said we're set up for a consolidation at the moment. This is classic news flow, doing the job of putting a narrative to what the chart pattern is. So as I say, DXY effects, we always need to look at that. And is it a risk on, risk off? Wednesday's the day it looks like you need to trade. And as I said, once we look at charts in a moment, the Trump and geopolitics probably just putting the bias to a positive DXY, and that is hence why we're in a risk-off period for now. So we're back in the land of the chart, and I've been talking about the DXY, the dollar, being the driver for risk-on, risk-off. And we've had this target of 104 kind of area. Now that's really beginning to develop now. So a lot of the volatility that we had around Friday's inflation data, that very much looks like it put in the B wave of that ABC consolidation that's going to make up the 104 target. Remember, the A leg up should equal the C leg as our first starting point. Is there anything else that you can put in? So I like these fib extensions, and it very much looks like we're in the middle of a third wave up. Within that, 5 waves that makes the final leg. That's where you'd expect lots of extensions to happen. So if we measure the first leg up from Friday's low and then apply the fib extension, these are all classic fib levels. So you've got the 1 spot 618, the 2 spot 618, and the 4 spot 236. Well, that just happens to line up with the target level of the A equals C. So we've got 2 very powerful Fibonacci levels matching up around what we thought the target level was. Now that could well be where the third wave finishes before you get one more 3-wave pullback and a final move that takes us up to 104, 105 before we're back into proper risk on mode as the dollar goes into its third wave down. That will be a powerful move and should generate the upside we were talking about previously for Q1. Just flipping into the 15-minute with the Bollinger Bands on. I mentioned it briefly earlier, but hopefully you can now see on a larger scale here. So what you do is pick just the simple Bollinger Bands and add them to the chart. They'll both be set up as 2 to start with. Just go into the details and edit and make one of them have a 1 standard deviation. And then it's quite powerful as a starting point to make you get interested. So once these things start to converge, you want to start getting interested. And then an entry into that top band, you want to play it with stop losses around the 1 standard deviation level. Like, remember that what we're using is a 75% of that band taking place below the 1 standard deviation level. Now, if you'd have bought in on entry here, you wouldn't have been stopped out because look, it was only a small amount there. But subsequently, you're out because all of it is taking place. You can stay out, go back in once it re-enters, and again, you've got all this upside, and you're going to capture quite a bit of it on the first time we've got a bar. So these are really powerful, and if it happens to line up with what we've just been looking at before, where we're having multiple Fibonacci levels to the upside for what looks like a wave 3, that's going to keep trending up on the top side. So, this is a time to start getting interested when you've got a 3-wave move down. That's starting to make you think there's a consolidation happening, and it's also gone into the reverse here, into the downside channel of Bollinger's. This is now time to start getting interested. Or it has clipped outside. So remember, the first rule of thumb was always that it would cross to the side. It's then being careful not to get walked up or down. So this is on the radar, but we need a little bit more data before we take it further. So let's see what effect the dollar is having on the gold chart that we've been following quite closely. So this, again, I've not updated the arrows until you've come on board here. I want to demonstrate a point. Is that was our idea, that we're in this 5-wave final move down, which would correspond with a strong dollar to bring us down to the 4th wave of 5 to the upside, which will eventually give us an all-time high. So it very much looks like we are entering into an area which is probably going to sell off quite aggressively. It's the inverse of what that strong dollar chart looks like. So where could we expect this 3rd wave to go to? So again, let's go and put in a Fibonacci extension. So we'll start from the top of 2 to measure the first leg move down, and we want to see how that from the top of the consolidation is going to look. And you can tidy these up on the settings. We don't need anything below 1 because we're looking for that equal legs and beyond setup that we keep talking about. So look at this, the extension levels for Fib, 1.618. Well, that's not a million miles away from where we are now. So at some structure level within this current move, highly likely we're going to have a pause, but we want to know where to put this 3. So automatically, let's have a look. 4.236 looks in that ballpark area of 1960, 70. It's a breakout of the 2000. Somewhere we'd expect a 3rd wave of a 3rd wave to progress to. So let's bring that down, and we'll adjust the rest of the chart across. So this is instantly areas where we should be expecting this, what they call an impulsive sell-off. We're going to have to end up. We're going to obviously have movements around, and I'd like to use the Bollinger Bands to tell us. So from that previous chart we looked at, it very much looks like this consolidation is taking place before some micro level before we carry on with the 3rd level down. It may take a couple of days. It might happen today because it looks like we're running out of time for that dollar strength before we move into what is going to be that risk-on phase. Every chance we get a macro data to help. Geopolitics unwinds a little bit. We get a decent inflation print from the US, or they actually, as I said the other day, if you look at the second derivative of information, the rates of change very much looks like there's every excuse the Fed could go. So you never know, there might be an unexpected development to even bring in that unlikely March cut that the market has been focused on. That suddenly comes to fruition, or looks likely, we're off to the races. So this whole chart setup could accelerate markedly. So just as a reminder of what that setup is, if you look at that weekly long-term chart, we've had a third wave and we're working out what the fourth is. So if we go into that, and let's just zoom in a little bit. We're expecting this fourth wave pullback, of which we think we might be in the C wave of 5 down, because we've had a down and up, and now we're in that final sell-off. 1920-ish was an idea, wasn't it? The 2039, 5 or 6% down before we're off to races with at least 15% upwards. That's going to need some very risk-on environment, interest rate friendly, it would seem, or something quite horrendous on the geopolitical side. But let's hope it is the former, not the latter. So by now you're thinking that I'm completely obsessed with gold. Well, I am in the short term because, like I said before, I'm doing some work in that space. But I like it. It's quite an instructive chart and heavily commoditized and traded. So there's lots of information to be had. So again, let's just have a look at a few things to tie up some loose ends. So you've got this situation where it's dropped outside the band. You're expecting it to at some stage cross to the other side, but we have to be careful again about being caught in those extreme bands. And look, you've got a move up and you've had some consolidation action, but it's never quite crossed the divide, and it's actually come back here and put in a negative. So it's time to just check out. Are you going to get, because there's none of the body taking place here, it's just a few prints in the 15-minute time scale. So you're not completely convinced, but we're in this low volatility zone, which we know is going to break out one way or the other. So again, let's just put in a little extension, see what that suggests. So from that low into the relative high, going back down to that low, where would an equal legs be? Then, you'd be expecting it to break through here, back up to the 2050 level, and then that there's potential for extension until the Bollinger rule breaks down. So that, in that case, you'd have probably been encouraged to have a go. Quite likely, if you're expecting a big move, you could have used the previous low as your stop loss. So you put in there and got potential gain. You'd have a decent risk reward ratio. But a lot of this is nuance as well as the testing. You've got to be sharp and be all over it. It's not something you can just walk away from. And there are just numerous examples of this all happening. So have a play with it. Have a look. I think it's a useful tool that I've used for many years and often gets you in the right ballpark. And then you've got other tools that you can bring in to try and confirm it. And obviously, I like to jump out sometimes to the hour zone just to find that confirmation. And again, you're seeing a lot of the trending still taking place even over the hours. So you're looking for a double confirmation of a longer time frame and a shorter time frame. Combined with your stop losses and do the fib levels match up, you've got a chance of beating the house, haven't you? So hopefully you can use some of those tools. I'm sure you've got others that you like in combination with the macro points you're looking for. Hopefully you're having a good time out there. Be careful with your trades, and we'll speak again soon.